Welcome to today's video where I'll unpack everything you need to know about multifamily syndication in under 4 minutes. In simple terms, multifamily syndication is like an alliance where like-minded investors pool their capital to acquire apartment buildings. And pooling capital goes beyond just numbers. It opens the door to substantial purchasing power, allowing you to unlock larger and more sophisticated deals and invest side by side with experts in the real estate space. This leads to a symbiotic partnership of general partners and limited partners, with each playing an important role. General partners, also called sponsors, contribute a small portion of the equity but handle the majority of the deal's operations, from finding the deal to making the day-to-day decisions. On the flip side, limited partners are passive investors, contributing the majority of the equity with limited involvement and limited liability. Together, their common goal is maximizing rental income and boosting property value. And from there, the partnership will share the rental cash flow and the proceeds from a sale or refinance. So let's imagine a partnership that's acquiring this apartment building. Let's say 70% of the purchase price is debt and the other 30% is equity. The debt may come in the form of a bank loan, while the equity is funded from your partnership. In this example, we'll say the general partners put in 20% and the limited partners cover the rest with 80%. Next, the general partners will execute a business plan, upgrading interiors, exteriors, and amenities so they can attract premium tenants and maximize the rent they can charge. The second objective is to overhaul the management to increase efficiency and streamline the property's operations. By doing so, this will grow the income generated at the property, which ultimately boosts the property's value. Now, let's get into the return structure. The syndication return structure aligns the interests of limited partners and general partners through an equity waterfall, which precisely outlines how the cash flow will be split between them. At the heart of this equity waterfall is the preferred return. This represents the minimum return expected by the limited partners, which is determined by the project's risk and their role as the primary investor in the deal. Typically, it'll fall between 6 and 10% on an annualized basis, and commonly it's measured using the internal rate of return, or IRR, which is a time-weighted annualized perspective on the investment. Most importantly, returns over and above this preferred return trigger a promoted interest to the general partners. So in this example here, with an 8% preferred return, cash flows are initially split 80-20 between the LPs and GPs, which is proportionate with the amount of equity each side invested. However, over and above that 8%, GPs gain an additional 10%, resulting in a 70-30 split. This extra 10% to the general partner is what we call promoted interest. There could be a few more hurdles or thresholds in the waterfall, like this 12% hurdle, which triggers another 10% promotion for the GPs, making this split 60-40. And then a residual split at the end here, where the cash flows over and above 15% are split 50-50. This structure creates a mutually beneficial scenario for both general and limited partners. General partners are motivated to maximize returns as they earn promoted interest only when the deal exceeds specific milestones. Meanwhile, the limited partners accomplish their passive investing goals by earning their preferred return plus a substantial share of additional cash flows. Thanks for watching, and I hope you enjoyed the video. If you want to learn more about multifamily syndication, feel free to reach out to me or watch some more of my videos.